Hi, my name is Beat Nussbaumer from microbeat.co.uk. What a week we had with tremendous rallies in the bond market, falling yields across the world that started to sort of give us some recession fears. A lot of chatter about inverted yield curves in the US, which people call like usually as a sort of sign for a recession within 300 days, which I think it's all a little bit premature, but you know, fair enough, there are definitely things happening, and we're going to be looking into a few of the markets that we will cover today. The first slide we see is the Australian rates versus the cash rate from the RBA. We've seen tremendous rally in Australian bonds. We hit new all-time lows in Australian bond yields, which is just a real worry in a sense for the market of what to sort of make out of it. Clearly, this is all driven by the global slowdown in economic activity, while the market is still kind of leaning on the hopes of some recovery after should we finally get a US-China trade deal. But actually what bond yields are telling us is the market is quite worried. The next slide, I would like to show you the Aussie dollar. So the Aussie dollar has been, or trades near the sort of lows of the last few years, and I think it's very easy to see what could happen to the Aussie dollar should this current weakness in China or the global worries around growth continues, and the break of these sort of multi-year lows down here, which just suddenly start to give us a stark reminder of the levels that we have seen during the 2008-2009 financial crisis. The next chart is a Bund versus JGB spread chart. This is quite astonishing what's been happening to the German bonds in the last few weeks, obviously fueled by very weak German data. We have seen, channeled European weakness in the data, but in particular the market starts to get worried that Germany is actually ahead of a recession, and there is a lot of chatter in Germany that they are preparing for a recession. What we see here as well is we are back to the 2016 levels of this spread, Bund versus JGBs. And on the next slide, we would see the Euro-Yen FX rate. And I have sort of drawn in this sort of flat green line, which would be actually where Euro-Yen has been when this spread has been last time at these kind of levels. So there's a clear dislocation somewhere between what we see on the yields versus what we see on FX. Obviously, correlations aren't always perfect, but I would really start to expect Euro-Yen to start to break lower and pay somewhat, lean on to what we see on the fixed income market. If we then go over to the DAX, the DAX has sort of just broken its 2019 uptrend, and this is obviously, another worry for Europe in that sense that the cheap money, the cheap yields are actually not helping the equity market at this stage. What is still amazing overall is that all the alarm bells that are going off in the bond market, where the market is indeed seriously worried about what's happening in the global space. From that side, I would think that equities are at risk of moving lower at some point. I can't really say when. The fact is that the market still thinks that the lower yields across the globe are actually bullish for stocks, what usually is true. But I think this time, given the bond market's tremendous rallies we've seen, or the tremendous move down in global yields, that should really be more of a sign of alarm, and we really start to worry whether or not stocks are going to roll over anytime soon. Personally, I think I do expect stocks to roll over anytime soon. It just cannot be that we have the volatility that we see in the bond market while the stock market is relatively quiet. The same is true for FX. FX is probably just a little bit confused given that the yields globally drop. So it's very hard to see a big sort of divergence between two countries. But on the back of it, I would think with expecting stocks to sell off, I would think that the typical risk-off trades will come and return, which we will see the yen should be the best pair in the weeks or months ahead, with what, like the chart I showed earlier on Euro-Yen, should be a clear risk on the downside for Euro-Yen. This is really it, and I hope you have a lovely weekend and see you again next week. Thanks very much indeed. Bye-bye.